Hello to all the debt warriors listening, and welcome back to another episode of Millennial Debt Domination. I'm your host, Katie Fata. A long-term investment is buying and holding investments for an extended period of time. Long-term investors are often willing to accept more risks in exchange for the potential to earn higher relative returns over time. Long-term investing is a strategy that has multiple benefits, including cost savings, tax advantages, and compound interest. Today, I'll be talking about long-term investing and how you can get started. I'll be joined by Winnie Sun. Winnie is the managing director, founding partner, and a financial advisor at the Sun Group Wealth Partners. Winnie joined me on the podcast a few years ago to discuss the basics of investing, but today we'll be going one step further and discussing long-term investing. Winnie and I will be discussing the benefits of long-term investments, paying off student loans while investing, the difference between short and long-term investing, and much more. Now let's get to my interview with Winnie. Hi, Winnie. Thanks for joining me on the podcast today.
Oh my goodness. Thank you so much for having me, Katie. It's always great to talk to you.
I know. I'm so glad to have you back. We haven't had you on in quite some time since the first time we talked about just basics of investing. We talked about investing for beginners. So today we're going to get started with long-term investing. So investing is allocating resources with the expectation of generating an income, profit, or gains. But what is long-term investing? Let's start with that.
Well, long-term investing is making the decision that what you're going to do is you're going to create routines and patterns so that in the future, you'll have the means to support yourself. And most important, to cover those important financial goals that are really important to yourself.
Yeah, definitely. And obviously covering long-term financial goals is important, but what are some other benefits of long-term investing?
I think it's really sort of a mindset. You decide on that day that you're going to make a choice to have a better future. So not only does it give you a chance to invest your money today, but it also helps you weather the storm. So obviously when you invest in the stock market, there's going to be days where the market does better than others. Well, when with a longer time horizon, you have a better chance to increase the odds of having better performance. This goes beyond just the stock market. In fact, we know the real estate market is this way as well. And it's just developing a really great set of sort of patient investing patterns for the future. And if you have loved ones, you've made a decision that tomorrow will be better, and you just decide that you're no longer going to accept that you're going to be in debt or that you're going to have bad financial habits. You're making a decision to be better in the future.
No, definitely. Those are some great benefits of long-term investing. So you mentioned real estate and stock market investing. Those examples of long-term investing for people?
Absolutely. I think, investing could be a number of things, but for the most people, long-term investing would be investing in the stock market or investing in your 401k or your IRA and saving some money for your child's education, maybe saving money, to pay off your house in the future. So, right, an investment, your real estate, if if it's your own home or even income property, that's definitely an investment as well. We know that most mortgages are 30 years. And so truly long term.
Yeah, no, definitely. That's a great point to make. So, you just named off a bunch of different examples of long-term investing. So how can someone determine which long-term investment is right for them?
Well, Katie, I think it's really doing that deep dive and figuring out what your financial goals are. And I know you and I have talked about this online a lot. You figure out what's most important to you, and then you rank them. I would rank some for short-term goals, midterm, and long-term goals. But if you really focus on long-term goals, these are those big, lofty things that you feel like they're really overwhelming, but you know that over time you can start to chip away at those goals. So like kind of like the ones we talked about, the big ones, like paying off your home, saving for college, or making sure that you can retire on your terms in the way that you want to. Those I think are probably the most popular long-term goals, and then there's others like, saving for a down payment or paying for my future wedding or things like
Mhm.
that. Maybe, because everybody's definition of long-term is differently. And typically my clients ask me, well, what's really a long-term goal? And I said, typically when you're talking about something, 5, 10 years longer, we would categorize that as a long-term goal.
Yeah, and that is a good point to make. Long term could be different for so many people. You brought up a ton of great examples, and I think it's also great to that you mentioned the short, mid, and long term goals
Mhm.
because those short and mid goals are what keeps you going to obtain your long term goals as well.
Right, absolutely.
Yeah. So when do you recommend a person invest in a long term investment?
Well, I think, there's not a specific age, but I would
Hmm.
say it's sort of a mindset. I
Okay.
remember I started saving for retirement. I was probably around no, maybe like a little bit older, probably like about 19 years
Mm,
old.
okay.
I remember my accountant at the time, because I had started a business in college. And I remember him saying very clearly, when you get your batuti over to the bank and open
Hmm.
up an IRA.
Hmm.
Now, I had no idea what an IRA was. And certainly when you're like 19 years old, you think of retirement as being like a month away.
Yeah.
But I knew that saving for the future was important. I knew that I didn't need the money right away. And I figured I wanted to make a smart adult decision, and saving money for the future sounded like a good idea. So I think sometimes we overthink things. Like we need to know everything. We need to have so much money. We have to know everything we want to do in the future before we even start. And that's not the case. If you even feel like it's important for you to save for the future, that should be a signal that you're ready to start saving for future long-term goals. I would highly suggest doing a lot of research online, sort of to learn the terms and get comfortable with the concept of what this long-term investing thing is. But you don't need to know everything, right?
Hmm.
Obviously, there's like AI and ChatGPT are super helpful for things like
Hmm.
this these days. But then from there, I would seek out a financial advisor or a professional who does this for a living, and ask someone for a free consult, spend some time figuring out what you don't know, and getting a little bit of free advice in the way before you make that first investment. And then once you do, that way it kind of improves your odds of having a good experience of investing well.
Yeah. And yeah, I like that you said it was a mindset because I think a lot of people always feel like they need to put an age on something. Like by 25, you need to start investing in this and you need to retire by this age. But it's all about the mindset, really. You need to get your mind behind it in
Mhm.
order to actually be successful at investing and such.
Absolutely, 100%.
You mentioned that you were 19, so young when you started thinking about investing in your retirement. And that was obviously before you had graduated college, I'm assuming, and maybe
Mhm.
acquired some student loans that people may have when they graduate college at that age.
Yep.
So, I always say, like, to my listeners and to everyone, start investing as soon as possible. But a lot of people my age still have student loans. So, do you think it's still impossible to invest while you're making large monthly payments towards your student loans? And if so, how do you recommend someone doing that?
Well, Katie, it certainly isn't easy. So
Yeah.
I had student loans back then
Hmm.
too, but it wasn't to the degree that student loans are at now. And
Hmm.
so to say that student loans should be paid out completely before you start investing, I think it's just, it would be nice if we can get them paid off, but for many people that's not a reality. So I would
Hmm.
say this is, part of the beauty of investing, and investing when you're young, is having the experience of investing, of learning when the market does well and when the market doesn't do well, and the importance of setting up these routines and patterns of adding money towards our future. So when it comes to student loans, yes, you got to continue to pay them off because we don't want to continue to accrue interest. If we start to invest, though, the risk is that we invest and the return that we get on our investments doesn't even keep up with the interest that you're paying on your student loans. So what does that mean? Does that mean we don't invest? Well, I think it's really sort of some soul searching. If you feel that, because you have student loans and you're seeing this interest rate continue to, charge interest on your debt, that it doesn't feel good, then go ahead and pay your student loans off
Hmm.
first. You can always set up a phantom or pretend investment account, and you can try to like learn investing that way.
Mhm.
But the truth is that you don't really learn how to invest until you actually invest. And when you lose money, you learn. That's part of the
Mhm.
education. And you do well, you learn too. So I'm okay with doing both at the same time. I would
Um,
just caution of investing too much. So certainly the majority of your disposable income should go towards paying off your student debt to free yourself of that burden.
mhm.
And then you can take a smaller percentage, and putting that away into investing is a good thing too. Now, what I would say this is, if you have debt, this is even more reason to get guidance on how to invest. I would not go and just, buy that penny stock or the stock you heard about on social media or
Mhm.
TikTok, or they talked about on Reddit. I wouldn't do that. If you're going to do this, you should seek out advice, stick with something diversified, maybe look at an index fund or an exchange traded fund, something with diversification, and then start small, because we know that human nature has shown us time and time again that people invest at the high and people sell at the low. That's really sort of that, when you're a newer investor, that's the way you do it.
Mhm.
So there was risks to that. So not only are you paying your student debt, you're paying higher interest, but now you're risking your hard-earned money that could go towards paying debt. So I would just caution before doing that. There's always time. There's always something to buy if you have money in your pocket in the stock market. So don't feel like you're losing opportunity. It's better to get that debt paid down first.
Yeah, definitely. And even if you do start out small, that's okay because you are still learning. And I love how you pointed out too. I feel like nowadays I hear so many people investing in things because they saw it on a TikTok or Instagram or something. Maybe don't do that. Definitely do your research first. Definitely. So
Absolutely.
what are the risks involved with long-term investing? And what advice would you give someone who is nervous about making a long-term investment because of risks?
Well, Katie, this is what I would say is, you're afraid of a long-term investment because of risk. You should be more afraid that you don't invest, and then you're going to look back and you're going to regret that you didn't save anything for yourself when you're much older and you're dealing with kids and households and aging parents, and like thinking about when you want to retire and you literally have nothing saved. I think what you don't want is, you don't want investors remorse.
Mm.
If you have the ability to invest today, and you can handle the up and downs, and what I mean by that is that your job pays you enough income to support yourself, then you should be actively investing. And if you're worried about this, do know there are trained professionals that will help you with this. And it comes at such a reasonable cost. Like, I've been investing for my clients for over 2 decades.
Mhm.
And the time it takes to learn, I mean to earn, the time to take takes to earn takes, skill and also discipline and a lot of other things, and a little bit of luck. But the time to lose money in the market takes like, a couple seconds, and you can lose 1 to 2% easily in a couple of seconds. So to get really good financial advice, to have a really good financial advisor help you, we're generally talking like 1 to 2 to 3% a year, right?
Mhm.
And knowing that you could lose that in a matter of minutes in a day means that with good advice, you'll feel more confident. You'll make better decisions. You'll have someone to kind of watch over and coach you through this process. And I will say that when you find the right advisor, they will change your life for the better. And I hear this all the time. And I truly believe this. Like, even if I wasn't doing what I do today,
Mhm.
I would still have my own money with a financial advisor. I'd have my family's money with a financial advisor, because we are basically day in, day out reading, studying, watching trends, learning about different investments, different styles, and different techniques that, when you're not in the industry, you don't realize how much goes behind building a really proper portfolio. So that's what I would say is, don't fear. There's people out there that can help you. If you want to DIY it yourself, that's great. But
Mhm.
at some point, serious money deserves professional management.
Yeah, no, definitely. So once you've kind of find a financial advisor, you've done some research, you've gotten advice on long-term investing, what are some strategies you can use to get the most out of your investments?
Okay. I would
Mhm,
say auto pay, auto day, all day
mhm,
long. So auto pay, auto investing is sort of the best way to build wealth without spending all your time looking at your portfolio, which is really unhealthy. So just like your 401k at work or your Roth IRA or traditional IRA, you should set it up so that money is pulled out of your checking account
mhm,
every single month consistently without you thinking about it. So you can go on your day and be brilliant and go on vacations and, surf TikTok and Instagram
mhm,
and not worry because knowing that you're still investing consistently every single month. And the same goes for, as you and I have talked about on social so many times, auto paying and making sure that everything that you owe gets paid automatically as well. And that's the key. So you should have sort of a combination of both. Have a portion be auto saving, auto investing, right? Money automatically going in. And then also sort of spend a little time investing, learning about the financial market. So let's say, for example, like my mom goes to Costco and she
mhm,
calls me, she says, I heard it, the market's terrible today. I was like,
mhm,
it was. And she's like, oh, I probably should have invested somewhere. I'm like, well, you did because you have you have automatic savings.
mhm,
But also, if you have a financial advisor, or even if you do this yourself and you see that the market's been down 3 or 4 days in a row, and you have a little bit of extra money in your checking account, why not invest a little bit more or be more strategic? So have the majority of your money invested automatically, and then a little bit of it, so kind of like that spice on top of your food, a little bit of it being strategic. And I say that is one of the best ways to invest long term for
Yeah.
success.
So even though like you have your investments on auto pay, you should
Mhm.
still be checking in with your long-term investments, right? Like,
Absolutely.
yeah, and
Absolutely.
how often you think you should be doing that?
So for our clients, kind of it varies. Most of our clients will do a portfolio review twice a year.
I see.
And we have a lot of clients that do it also once a year or on a quarterly basis. So it just depends. Like
Okay.
I always say that if you have more things happening with your portfolio, then quarterly makes a lot of sense. We have some really large investors. We even have some like YouTube creators who just have a lot of income coming in. It kind of sporadic. So it requires a lot more maintenance. So it could even be monthly or quarterly. But for, let's say you're just starting off and, it's your first job, your life's pretty simple. You just got like bills to pay, but, you don't have a lot of stuff going on. Then once a year is fine. So it really depends on your needs, but at least check your portfolio. I would say if you don't have someone working with you, at least check it twice a year. Tax right around tax season is good, and then the beginning of the year is a really good time as well. And then once you know where you stand, then you're good. I wouldn't look at it every day or every week. It's
Mm,
really unhealthy, especially
mhm.
if you're the type of person that gets nervous whenever the market pulls down. Uh, you know, we do this for a living, so we're kind of immune to it. But for most people, you really should check it less if you're managing it right.
Yeah, no, that's definitely some good advice because I feel like if people are checking it so often, they're going to get obsessed and maybe paranoid even, and then they might think they have bad thoughts. So
Mhm.
checking it less is more, you'd say.
Yes, yes.
Okay.
Yeah, absolutely. I mean, people always say like, I should have bought such and such, because it's up like 3,000%. I'm like, you know what? If you look at every day, you probably be stressed out because there's gonna be days that it was down. Just like, the home that you own, you're like, oh, it's up so much since when I bought it. Yeah, but if you actually knew the market value of your home every day, you probably would have sold it like 6 times by now.
Right. Right. Definitely. So when you're checking in with your long-term investments, this is a good time to review your investing strategy, correct? And maybe make adjustments if needed too.
Right. So though you should check up on your portfolio and you should figure out, okay, number one, is everything doing well the way I
Mhm.
expected it to do? If it's not, then great. Am I out of, allotment? So for example, let's say I had I'm supposed to have 30% large cap growth. I'm supposed to have 10% small cap value, whatever it may be. Am I now at 40% large cap growth and like 5% small value? So maybe I need to rebalance my portfolio, right? This is what we do. So rebalancing, that takes time and a little finesse. Make sure you do that correctly. And then you should reassess like how much you're putting away every month. If you challenge yourself to put away 10% every single month, now it's the time to try to do double, do on 20% and see if you can survive on that for the next month. And if you can't, then you can come down to 15% or 18%, but you should consistently continue to challenge how much you're putting aside. And that's what we do for our clients too. That's another thing is you should definitely have a financial plan. So financial plan does is it tells you how much money you need in the future and what is your yield bogey each year. So that way it says, okay, great. So Katie, you got to be saving at least, 5,000 per year, and you need to generate at least, let's say, a 7% rate of return each year. And if you do that, then maybe you'll be able to retire at such and such. That's just an example. So what you do is then come January, you take a look at your portfolio. Okay, great. So I put away 5,000 this year. Oh, wow. My return this year was 8%. Great. I'm on track. Then this year I'm going to challenge myself and save a little bit more. But what happens if this year you still did the 5,000 and you were successful there, but your portfolio only did 3% this year because of a pandemic, because of a war, because of any other factor, right? So what do? Then you can make a decision. Okay, this year I'm going to put away another $1,000. I don't want to, but I can and I should. And the reason that is because you don't want to wait until you're in your 70s and 80s and like, oh, wow, I thought I would be okay for retirement. Now I know I have a shortfall. It's better to know each and every year so that you can make up those years on those more difficult years.
Yeah, you don't want any surprises later in life when it comes to money.
That's misery.
Yeah, exactly. So, what's the difference between short term investing and long term investing?
Well, short-term investing is typically what we consider less than 1 year of when you're going to need that money, or at the most 3 years, 3 years or less, right? So short-term investing means I really need this money. It could be like I'm paying for my wedding or I'm paying for a down payment on my home. I don't have a lot of time for second chances. So that means that the investments that you select should be, in theory, more conservative. So this could be CDs, it could be a savings account, it could be, things like that are just a little bit more conservative. Long-term investing, because we got more time, it gives us a chance to come back if the market doesn't do well. So typically a market cycle on average, you have 4 up years and you have 4 down years. Now there's going to be exceptions to that. We've seen that since from 2008-9 until the pandemic, the market really had a very, very long run, which exceeded 4 years. But most of the times you should expect that market does well, market does poorly, right? Right now we're obviously experiencing some challenges. So at some point that'll come back. So you want to have more time for your portfolio to recover as well.
Yeah, got it. That's a great breakdown of long-term versus short-term investing. And then, we've talked about this so many times too. Everybody's different. Everything is going to be tailored to different people. But I would just say, just in general, do you recommend people make both long and short-term investments? And if so, what are the benefits of having both?
Yes, I think everybody should have short and long term. And if you're like really on top of it, you could even do a midterm. I mean, but I think in most cases, short and long term is just fine. And that's how I kind of manage my own money as well. I think it's important. It's important to have a plan in place. The more you can plan your finances, the better. And it doesn't take that much time. It's almost like a mental plan. You're like, okay, well, I'm going to make sure that I want to have a vacation in 3 months, And so what that means is this is how much I don't want to come back with debt. I want to make sure like my hotel is covered and my flights are covered. And this is what I'm going to pack. And these are the clothes that are wrinkle free. It's the same as making a packing list, but you make it with your money as well. So that's sort of your short term. And then your long term, right? We talked about that. Right. So the more you can get in the habit of planning out your financial needs, the more it becomes just a habit. And then so it doesn't become this big drawn out thing every year. Just mentally, you're not, I'm going to go somewhere, I'm going to make sure I have the money. And I'm committing to coming back with no debt. Like I just like that I always say that my favorite vacation is coming back where I don't have anything to pay for on my credit card except for a little bit of food.
Mm-hmm.
And that's good. That's considered a really solid, great vacation.
Right. No, definitely. You don't want to be in debt from that. So planning your finances is always important. And we talked about short and long-term investing. So that would be considered diversifying your financial portfolio, right? So maybe can we talk about diversifying your financial portfolio and the importance of it?
Sure. So we know that, Murphy's Law is when you invest, the market goes down. When you sell, the market goes up.
Mhm.
Unfortunately, you want to try and minimize your Murphy's Law as much as possible. And that means diversifying how you invest. So most of us are very familiar with large cap growth companies, right? The Googles and the Apples and the Amazons and Teslas of the world. We are familiar with bigger companies, but there's a lot of other smaller companies you may not be aware of. For example, there was like a legendary investor by the name of Richie Freeman. And so he was famous for buying Intel when it was like $3 a share. Now, there's going to be present day Intels that are at $2, $3 a share, maybe not even gone public yet, that you're not going to be that familiar with. So you're going to always gravitate to what we are familiar with and what you read, right? But it's important to have different things balance your portfolio out. So the best way I like to say is just imagine if you're going into a mall, right? And let's say you own the mall in your neighborhood, like the biggest mall in your neighborhood. Well, if you went into that mall and it only had, teen clothing in there, well, that's not really diversification. And what if teens just stop buying clothes, right? And they're just like, I'm good. I'm gonna become like one with the earth. I'm only gonna like commit to 3 pieces of clothing, and I'm like, your mall would fail. So you would need to have like a food court. You would have to have like household items. You have beauty. You'd have shoes. You have all these different things to kind of help out. Well, that same process is how you would want to build your investment portfolio. You don't want to be so concentrated in one area that one sector does poorly, that your portfolio goes kaput.
Mm.
And so that's the concept of diversification.
Yeah, that was a great example. I think that
Oh,
definitely
good.
broke down. I love that example. So, yeah, definitely diversify your financial portfolio for your financial life in the long run. So, how can investing impact your financial life in the long run? We kind of touched on this a little more, but do you want to break it down a little more?
Like, how does diversifying help with you in the long run?
Yeah, diversifying your income, investing, how can all of this improve your financial life going forward?
Well, I always say, like, we all work really hard for our money. And I really think that our money should work just as hard as we do, because if it doesn't, it's kind of slacking, and that's not cool. So I think that's the key, is that you should keep on working, bring in that paycheck, but that money needs to keep up at least with inflation. And we know that inflation has just been pretty miserable the last couple Years. But it hasn't always been. On average, inflation generally is like, healthy inflation is about 2 to 3%. Right now, we're still over 4%, which is not good. But the question is your money at least earning 4% or higher? And if it's not, then your money's losing money every day. It's not working hard. So that's sort of one of the concepts of diversification, is making sure that your money can keep up with your future financial needs.
Yeah, no, that's definitely a great point to make. And inflation is definitely going up and up every year. So it's important to invest now in order to make successful financial decisions in the future. I think you answered all my questions about long-term investing, Winnie. Thank you so much for joining me on the podcast today.
Of course, anytime for you, Katie. Thank you so much.
Thank you. And then if the listeners wanted to hear from you more, would you want to just tell them maybe about your chat, your weekly chat, or some mostly weekly chat?
Sure. And this is where Katie and I spend time on Twitter.
Yes.
So you jump on Twitter and you follow the hashtag Winnie Sun, one word, and it's every Wednesday at 11 a.m. Pacific or 2 p.m. Eastern, depending on where you're joining us, anywhere in between. And we would love to have you. You just have to jump in, say hello. We throw out about 10 to 14 questions, and then you get to answer questions. You get to talk to people like Katie, who we highlight a lot on the tweet chat.
Yeah, I try to be there as long as I can make it. And I'm going to put this in the description of this podcast, the link to the chat and all the details so everyone can get it there. But thank you so much for joining me, Winnie. I really appreciated it.
Thank you, my friend. It's always a pleasure to talk to you. And this is such a treat because I get to talk to you twice this week.
Thank you so much. Investing is a long game. Whether you want to invest for retirement or grow your savings, when you put money to work in markets, it's best to set it and forget it. Know your goals, your time frame of achieving them, and how much risk you're willing to take. There's not a certain age you should start long-term investing. However, you need to be in the right financial mindset. When you realize you're ready to invest, do your research, seek advice, and hire a financial advisor if you feel like you can. If you're concerned having debt, specifically student loans, is keeping you from investing, it's not. It's possible to still invest while making payments towards your student loans. Invest what you can afford while paying off your student loans. By actively investing, you're learning what to do and what not to do. And therefore, when you're done paying off your loans, you can invest more money already knowing what you should and shouldn't be doing. As with almost everything in life, there are risks to long-term investing. However, you shouldn't let these risks deter you from making long-term investments. In the long run, you'll be more afraid that you didn't invest, and you may have investor's remorse. Don't overly check in on your investments. On average, checking in on your investments twice a year is enough. This is the time to review your investments, see if everything is doing well, and change your plan of attack if needed. Make both long and short-term investments. Having both diversifies your income, and having a diversified income will impact your financial life in the long run. With that being said, that wraps up another episode of Millennial Debt Domination. Don't forget to subscribe to the podcast wherever you're listening. And if you're listening on Apple Podcasts or Spotify, please rate and review us there. I'll talk to you next time, millennials, Gen Zers, and everyone else listening. Bye.